Welcome to this video. We're going to try to introduce the next phase of this course, which is what do we know about planning, right? How does planning in the company ultimately affect value? So in this case, we're going to be looking at, again, financial planning, trying to determine whether we need extra money or not, additional funds needed. We're also going to be looking at how we forecast financial statements to see how our plans will affect, right? If we want to make change in operations, how will that impact our statements? If we change projects, if we change our financial strategies, etc., how would that affect the statements of the company? And then ultimately, how does that affect the ratios of the company and our performance? So we're going to be looking at forecasting, income statements, balance sheets, trying to see if we have any money left over at the end. Then ultimately, we're going to see how does that square up with our costs of financing. So we're going to look at some alternate operation plans, right? We're going to have a series of plans that we can look at to try to see how those decisions might impact performance of the company. We need to then forecast our free cash flows to see if we can estimate the intrinsic stock price. And then ultimately, once we have a plan in place, we need to know where we're going to get the money to do that. Will we have enough money in-house? That is, will we make enough profit and have enough retained earnings to finance the plan, or will we need to go outside the company for some financing needs? So we have a company. This is the balance sheet of this Hatfield Corporation. Here are their financial statements for 2019. One thing to kind of keep in mind as we move forward is that here is their line of credit, their short-term external financing is zero. They don't have any right now. We may ultimately need to use that. We also need to understand the relationships between debt and equity. So we have total liabilities. We also have long-term debt. How does that line up to our total assets? We'll see that here in a minute when we calculate some ratios. When you look at the income statement, again, a couple things just to keep in mind here is that we do have some retained earnings. We pay out $100 in dividends. That means $197 go to retained earnings. That is what we frequently refer to as internally generated capital. We look at then the ratios. In this case, we're comparing our company to the industry. You can see that there are lots of differences, obviously, in the values. Things we want to keep in mind, ultimately at the bottom here, our return on equity we see is higher than the industry. So we are providing more, or we expect to provide more return to our owners than what the industry is. Our operating ratio is less, though. Our capital requirement is more. And also, our return on invested capital is also less. So let's make some comparisons in general to the industry as a whole. Again, we have lower operating capability. We have worse capital requirement. We have lower return on invested capital. In fact, our return on invested capital, 8.5%, is less than the 10% cost of financing. So what this is telling us is that we don't make enough profit from our business to actually pay the financing costs of running the business. So that means we're not exceeding the minimum costs of actually running our business and the financing, of course. So we can't be adding value to the company. When we look at leverage, we see debt to total assets. We have more leverage there. And even you look at total leverage or total liabilities, again, that's even more. So again, we have higher interest payments. We lower operating profitability. Again, we're going to have some issues when we think about the leverage of our company. If we want to look at that return on equity number, remember we said that it's higher than the industry. Let's take a moment to think about this DuPont equation. It's a very important indicator of the decisions that management is making and whether or not they're actually generating return for the owners of the company. It's the profit margin multiplied by total asset turnover multiplied by the equity multiplier. So let's look at that in actually the equations. I think it's easier to kind of understand. Return on equity, right? So, excuse me, you have, if you look at the profit margin, it's less than the industry, 3.3 versus 5.6. It's less efficient, 1.4, less than 1.69, obviously. So the Hatfield company is less profitable, less efficient, but they're showing more return on equity. Why is that? Because they're taking on a substantial amount more debt. So the question, I think, as an owner is, wouldn't it be nice if they could provide more profitability, more efficiency? That would get these owners, again, they don't mind that the company borrows money. They mind that the company is not being as efficient and profitable as it should be. So one of the variables, one of the things that we will calculate here then is tell me about the funds that we're going to need to manage these moving operations, right? The new assets. So there are three things we basically have to decide or estimate. We need to estimate the new assets that we're going to require. We have operations, we're going to do some projects, we're going to buy things. What will the new asset base look like? From that, we'll subtract away any of what they refer to as spontaneous liabilities. This is really just accounts payable and accruals, but these are just created by doing business. So we want to subtract that out because they're just naturally created. And of course, they don't require cash at this time. We're also going to subtract out the internally generated capital, which is the retained earnings generated for this year. If we look at the table, again, we have our variables here. And again, some of these variables are not as familiar, maybe, as you might think. But spontaneous liabilities, I think, is the only one that's a little bit different here. But again, just think of that about being accounts payable. The other ratios we've all calculated or estimated in other forms in previous videos. So we need to know sales, the growth rate of sales, projecting sales, how much assets are we going to need. All of these things are required and determined through the data from previous tables in this particular video. So if we take the variables and we plug them into our formula, again, this is our assets that we require divided by the sales. So that's our capital requirement times the change in sales, right? How much assets do we need? We then subtract from that our spontaneous liabilities. Here's spontaneous liabilities to sales. Multiply that by the change in sales. And then we subtract out our retained earnings. What's the net profit margin? What is the sales that we expect in the next year? And then what is the retention rate? 1 minus the payout ratio. So in this case, it shows us that we're going to need an additional $310 million to finance the operations moving forward. Where are we going to get that money? Now, it's maybe not intuitive, but we've already included the profits for next year. So this $310 million is all external funding. How can the company get money from outside the company? The last several videos of this course will address that need.